Yeah, I mean, I think each country has its own little nuances, which both prevents new investment coming in, be that sort of funding structures, tax structures, zoning challenges around design, specification, especially in places like sort of Italy, car parking ratios in Germany, in France as well, would be that because of the nature of the asset class it's akin to a residential product, so it's following the same sort of residential design specifications. So you have to have one-to-one car parking in certain cities. In certain cities, it could be 1-to-4 ratio of car parking in Germany. I think many of those are actually sort of starting to change, as I think there's pressure on councils, local authorities to provide a solution to the housing crisis, be that for student housing or be that actually more around family housing, young professionals. In terms of where their returns are, Germany, as we've seen, is in terms of yield profiles, probably sort of keener than most other jurisdictions in Europe, largely because it's very much seen as a residential product. It's aligned to that residential segment. So it's, when we talk about, I think on the chart here we had about 3.8% as a sort of best in class for Munich on a net initial yield basis, not the sort of gross on the cold rent multiplier that we would look to appraise things on. In France, we're probably around Paris, depending on where you are in Paris, but sort of 5%, 5.5%. Again, the market there has been very much focused on developments, assets with leases in place to operators. So for investors, it's very much sort of a secure income stream. Whereas you go to Spain, again, it's very much a direct let market without that security. So as an investor, you're able to benefit from the rental growth that can be attained, assuming you're developing your assets in the right location.